It is a pleasure and an honor, quite frankly, to be here. I love coming here. I have good memories of here. Brad mentioned my son played baseball, so as you can imagine, somebody on the other side of the mountains who has a child who played competitive baseball all the way through high school. I think I've been in every hotel in these Tri-Cities, including this one, because we like to go where the weather is better. So great memories of coming here. My son and I were actually texting last night. I told him where I would be speaking, and of course he started telling stories about this tournament and that. And you know, he can't seem to remember to take put his shoes from one closet to the other, but he can tell me everything that happened in a tournament 6 years ago. And any of you, I think, that have teenagers can probably appreciate that sentiment. So it's a lot of fun to be here. And again, I appreciate the invitation from Brad, RBC, and from everybody involved in that. I also, it's fun for me. I realize right walking on here, fellow alumni of RE Long and Longview is here. So Todd and I are going to catch up afterwards. So go Lumberjacks. We're going to talk a little bit today, about 30 minutes, on a lot of different topics. We're going to do a very brief recap here of 2013. Interesting, wonderful, strange market that we had in 2013 around the world. I'm going to spend most of my time, though, talking about 2014. The markets will tell you on any given day who won and who lost and how things went. So we don't need to spend too much time looking back. But January is always a good time to look forward and say, what do we think the markets look like? So we'll talk about the U.S., where the story is pretty good. We'll talk about large international markets, developed markets, mainly Europe and Japan. We'll hit on emerging markets, which are certainly back in the news a little bit, and we'll hit on interest rates. We'll do all of that, save some time for some questions. I do have some slides. I know they won't be easy for everybody to see. Don't worry about it. I'm going to walk through those, bring out the main points. I'm going to hop around different places on here. So if you don't want to see slides, if you've been PowerPointed to death, don't worry. This one isn't going to be slide by slide. And for those of you that are visual learners and don't want to just listen to somebody for half an hour, I'll have something for you to look at as we go through, so hopefully everybody will be happy. This is our quarterly economic review. There's our compliance slide, by the way. Everybody take time to read that one. There'll be a short quiz when we're all done. I think there's a few more of these at the back. But this is a quarterly review that is done by, it's put together by 5 or 6 of us who do a lot of this. We travel the entire country. Another reason I'm glad to be here is there's really nowhere east I want to be this time, this winter. So I'm slowly working my way across the country, very slowly. But this is put together by a group of us that travel a lot. We do a lot of meetings with advisors who use Russell, as well as a lot of end investors. We do a lot of Q&A. We hear a lot of questions, but the questions are usually pretty similar. Within quarter, there are usually 4 or 5 different things that I don't care which side of the aisle you're on. I don't care how many zeros you have in your balance sheet or don't have in your balance sheet. Everybody has the same questions. Now, they change a little bit from quarter to quarter, but within quarter, we hear the same things over and over. So that's what we build our quarterly review around. We try to keep it pretty tight, pretty short, try to put in some graphics and hit on things that we think are really where your head is at when you walk in and want to talk about what's going on in markets. So that's the spirit of this one. I'm already going to skip forward a few slides. And let's briefly talk about last year. Now, again, if you can't see all the numbers and the asset classes on here, don't worry about it. I think the main visual takeaway is this. You can see the zero line about 2/3 of the way down in the numbers. There's an awful lot of things, whether you look at current quarter, 1 year, 3 year, 5 year, that are above that zero line. Despite the volatility and despite everything that we have had to process, not only in the United States, but around the globe, particularly over the last 5 to 10 years, if you stayed in any sort of a diversified portfolio, you've done pretty well, particularly as you now go out 5 and 10 years. They're all above the zero line. So I think sometimes it's nice to remind everybody the markets have actually done pretty well. the hardest thing about these markets, quite frankly, has been staying in them. And you don't usually get a lot of help with that, particularly in what you will read and in what you will see on TV. I think they all know that we tend to be wired to almost want bad news. If we were always saying we wanted good news, then that's what would always be seen. But that doesn't seem to be the way that they're wired. If the news is good, we seem to change channels, and when the news is bad, we seem to zero in for hours. I mean, how many people have spent more than enough time today looking at the weather in Atlanta, right? Not exactly a feel-good story, and as a traveler, I feel horrible, and I can't imagine my child being one of those that was staying either at school or in the school bus at night, but we all gave it more than just a casual pass-through, didn't we? So I think that it's nice every once in a while to be reminded that the markets did well. Now, certain markets have done better than others, and you would think, well, particularly after a year like last year, what a great time to not only be an investor, but to be in this business. But if you think about what the markets did, it was actually quite challenging. Yes, the U.S. was up 30%. But think about markets around the world. Japan was up over 50% last year, not 15, over 50%. Europe and other large developed markets were up 20%. They didn't get much news for that because 30 and 50 kind of took the headlines. Emerging markets were negative. Just think of the dispersion between markets of up 50 in Tokyo and Japan, up 30 here, flat to negative in emerging markets, and fixed income was also slightly negative, something that we haven't seen for a long time, but something you might want to get used to seeing a little bit more moving forward. So that can be a difficult investing environment. If you picked one or the other, or you overweighted one versus the other, you got dramatically different returns maybe than what you were seeing in the press. So we thought last year was actually a pretty challenging year. Again, if you stayed diversified, you had, I'm sure, probably double-digit returns in any sort of a mix that had a fair amount of equities in them, even with emerging markets being negative. So from that standpoint, from a family budgeting, what it really matters to me, do I have money to fund my retirement and fund educations and things like that? It was a great year, but as you looked at different markets around the world, you were either probably going, boy, I want more of that, or boy, thank goodness I avoided that. So a little bit of that comes through here, and again, we're going to talk about particularly U.S. versus the rest of the world, where we've been and where we think we're moving from here. So let's talk a little bit about our outlook of the world. So this is where we're going to take a quick trip around the world, and then I'll flip back and forth to some of these slides. Let's start here. What a great year in this market. Now, we thought last year was going to be a nice year for the States, but we did not see 30% coming. It's hard to predict up 30%. That's usually a pretty bold statement. And particularly when you think about, does that mean, boy, our economy's doing great, everybody's got a job? If you look at some of the backdrop of that, our economy was slowly getting better, jobs were getting better, inflation was coming down, but the news didn't really seem to warrant, wow, that means the market should go up 30%. Think another example of the cruelty of how markets work. Markets are forward-looking mechanisms. As I said, we know every single day. The market closes at 1 o'clock here for our time zone. You know how you did. You know the winners. You know the losers. Markets always processing information moving forward. The markets saw a world, and particularly a U.S. situation, that was getting better. Markets moved ahead of that. If you wait for the information to look better, oftentimes you've missed many of the market returns. So I think particularly as you try to wait for that information and that confirmation and then make maybe more tactical allocations, you've already missed it. That's what makes markets so frustrating. And I think last year might have been a year for that. I think some people were caught flat-footed. And as I do these talks year after year after year, I'm always kind of amazed, after an 08, people didn't want to be invested in the markets because it had had such a horrible experience. And just to put that into some context, I know you might not be able to see it, but this is the distribution of returns going back to 1926. Go to the far left, and there's 08. It's hanging out there with 1937 and 1931. Generally not good company to be out with. So that's an environment where you live through that and go, well, I don't want to be invested in markets. Look what they did, all right? Well, look what we had last year. You see it in slightly orange on the right, 2013. But right around 2013 and to that positive side, you get 09, 2010, 2011, 2012, 2013, a 5-year run. Does that mean everyone's jumping and running back into the markets? No. And now often what I hear is, well, the markets have done so well, I don't want to be in markets. So basically, people don't want to invest in markets when they're down, and they don't want to invest in markets when they're up. What a challenging business that we live in. And I think sometimes this visual look of what the markets have done, at least in the States, is helpful. One other thing I do want to bring to your attention. Notice the shape of this. Again, if you can't read the years, it doesn't matter. It skews to the right. What does that mean? It means markets actually go up more than they go down. Markets actually go up 72% of the time if you look over long time periods. It doesn't always feel that way. We don't seem to give markets credit sometimes when they go up, but we sure remember those 28% of the periods in which they go down. And sometimes it's helpful just to look at a visual presentation of a standard number we all talk about. You know, over long periods of time, markets go up around 8%. This kind of just gives you a feel for the pattern that follows. By the way, you know the amount of times in any given year that the market has actually gone up, what the long run average is? 0. It's always around that, but the average is around 8%. So let's get back to talking a little bit about what we see for this year in the United States. This is a tricky one for us because, again, we recognize that our value in our market has done quite well. You know, up 30%, a nice 5-year run. Yet, there are a couple things going on that makes it hard for us to take a bet against the U.S. in how we allocate our portfolios. Number one, the economy is actually getting better. For the first time in a while, we are actually predicting 3% GDP growth for 2014. Now, others have been predicting that for a while. Haven't quite got there. We've seen fits and starts of that number. We think that we are entering into a more sustained, at least 3% growth for 2014. That's a good thing. We think jobs will be about 230,000 added a month. We kind of focus in on the non-farm payroll number. I could talk for an hour. I won't on the unemployment calculation. There's many things that go into it. Sometimes it sends mixed signals. Is it really jobs being added? Is it people dropping out? Is it seasonality? Is it all the boomers retiring? There's a lot of things that go into that number. So we tend to just look at the broadest measure of jobs being added. Non-farm payroll is not a bad way to look at it. We see that at about 230,000, 240,000, again, average for the year. That's not too bad. Inflation, pretty tame. I know there's different ways to measure inflation. Maybe it's a little bit higher than it really is, maybe not. But we're certainly not looking at inflation as we've seen at different times in our history, like the 70s or 80s. Now, maybe we will see that again, but we're not there yet. So when you look at the U.S. situation, we're pretty good. If our economy's getting better, jobs are getting better, inflation's down. Federal Reserve, under the new Fed Chair Janet Yellen, they're certainly not going anywhere. They are not going to be increasing interest rates anytime soon. Unemployment will probably go through 6.5, 6, maybe even down to that 5.5 area. And if there's no signs of inflation, we don't really see the Fed increasing rates. What does that mean? For you CD holders in the crowd, enjoy the returns you've been seeing, because you're probably going to see them until at least the latter part of 2015 and maybe into 2016, which some people are saying, before the Fed raises rates. Now, in the meantime, the Fed is slowing down on that policy called quantitative easing that we all now know that term. To simplify that, that's simply the extraordinary action that the Fed has taken, both under Fed Chairman Bernanke and now will continue under Fed Chair Janet Yellen, in which they go into the market, they can't take rates down any lower than 0, they actively buy mortgages and treasuries, and they're continuing that. They're slowing down the pace. They announced just today they will slow that down by another $10 billion this month, probably continue slowing that down and winding that program up at the end of the year. So that will happen, but remember, that's completely different than when will the Fed actually raise rates. We think that's later into 2015 or 2016. But usually, if there's this much liquidity around, an accommodating Fed and an economy getting better, boy, I know we were up 30% last year, but I don't think I necessarily want to bet against the U.S. Now, I think the challenge for most investors is this. You probably already have plenty in U.S. equities. Most investors anywhere in the world have a home country bias when they put together their own portfolios. What does that mean? You invest more money in your home country. I don't care if you're a U.S. citizen, if you're Italian, if you're an Aussie, if you're Canadian. People put more money in their home country because they know it, they understand it. And again, think back to the media. How much of the media focus, no matter which network you're watching, is U.S. focused and data versus what's going on in the rest of the world? Here, it's almost all about the U.S. So you probably already have plenty there. I don't think you need to necessarily take that money away, but there might be some pockets around the world that you might want to think about throwing a few dollars to. So let's talk about a few of those. Let's go to the Eurozone. Europe and Japan, again, had very good years last year. Don't get all the publicity, particularly in Europe, because up 20, yeah, well, great. Up 30 and up 50, it doesn't make the headline news. I think there's more to go in Europe as far as on the upside. Now, are they growing as fast as we are? No. Now, the United Kingdom has put up some pretty good numbers lately as far as their GDP. Germany continues to kind of push through, and those are really the two lead economies that need to do the heavy work. They are the growth engines in Europe. They need to be the leaders there. Southern countries are at least kind of getting back to zero. The situation has gone from really Armageddon as far as it was portrayed in the press to just kind of a bad situation. Well, that's actually an upgrade. What do markets like to see? They love to see turns. Bad news getting less bad almost can be rewarded as much and sometimes more than good news getting great. So, all right, they're turning. And just think about the things that were being talked about in Europe a few years ago, or at least about Europe. People thought that, Europe was done. Nobody was going to spend money anymore. Well, I think people forgot that the 17 countries, plus in the Eurozone, plus when you put the UK, who doesn't share the currency, but we'll put them in, they're the largest collective economy in the world. They still spend money. The currency is not going away anywhere. This is an experiment that was started by Germany. It hasn't really been along that much in existence. They wanted it. They've got most of the money. They're not unwinding it until they've done many things that they haven't even done yet. Countries getting kicked out of the Eurozone got talked a lot, particularly with Greece, Cyprus, even Portugal. Spain was starting to get mentioned. We didn't see that happening either. So many things that were really, the markets got priced as if they were going to really just, this is it, we're done there. Haven't happened. The economies are getting a little bit better. You'll probably see some monetary action from Mario Draghi, which is basically their central banker, their Janet Yellen. It's more difficult there. Here it's very quickly, as we've demonstrated over the last years, to put money into the system. Easy to do it in Japan, easy to do it in Australia. Harder to do it when you have 17 countries and parliaments and treaties and kind of, centuries of killing each other in the background. A little harder to get a how do we move all together as one team, one dream, but they will find ways to get money into their system because they need to export their way out of this to both the U.S. citizens and the emerging citizens in order to help them through. But the stocks got very cheap. They're still cheaper than us. Their fundamentals, yeah, they're not as strong as ours right now. Our economy's in better shape, but their markets haven't traded up as much. Oh, it's always about a trade-off between price and earnings. So we, relative to others, we actually build our portfolios to try to remove home country bias. I wish we hadn't last year, but it's very difficult to time in and out of when you want to do that. More people are starting to recognize move money to Europe. I think Europe could continue to be a surprise on the upside this year. So since you might have portfolios that have a lot in the U.S., just think about as you have new money coming in, maybe throwing a little bit more into big markets around the world. Could be a nice time to do that. Let's talk briefly about Japan. Japan, fascinating story. Just think about what was in the news about Japan a few years ago. I mean, the country shut down. I mean, they have the tragedy. You have, nuclear reactors and just shutting down the country and tidal waves. And I mean, horrible, horrible stories. A few short years later, you have an economy that has some energy to it. They've done a tremendous amount of quantitative easing. You think we've done a lot based on the size of their economy. They did even more. Many would argue 20 years too late, but they finally got there. They had to get out of that deflationary spiral. What is deflation? Remember, it's just the opposite of inflation. It's when prices are going down. And you might think, well, that's great. Prices are going down. I love that as a consumer. But at the level of an economy, what does that impact? Why would you buy anything today if you think it would be cheaper tomorrow? You don't. That's Japan of 20 years. So they've gotten a little bit of that mentality out. They've helped their exporters by dropping their yen. It's filtering through to the rest of their economy, and they get the Olympic bid in 6 years on top of it. Wow. What a consumer confidence change that would be. I would think the average citizen in Japan, from where their head was probably at a few years ago versus now, there's a little bit more swagger walking down the street. When you have a little bit more swagger, you spend a little bit more money. So we don't see another 50% up year in Japan, but we think, at least in the short run, that there can continue to be follow-through there. Now, both Japan and Europe have a couple things going against them in longer time periods. Their demographics are not good, particularly in Japan. They don't have a lot of immigration coming into their country, just like Japan, and their debt levels relative to the size of their economies are very high, particularly in Japan. So we have to balance that with where we see shorter-term opportunities over the next few years versus longer run. Where do we want to be? We make allocation changes usually about once a year, and we tweak it on an ongoing basis. But we see opportunities, again, in Europe and Japan, and have continued to have a presence there in our portfolios. Let's talk about emerging markets, probably one of the more topical areas right now. We'll talk about China, but let's talk about it broadly. Emerging markets have been down over the last few years. Interesting psyche, though, on how, as investors, have we treated it. It was the place to be for about a decade until a few years ago. People put their money there, put more money there. Now it's actually selling at a discount, and in fact, by some metrics, 35 to 40% discount to developed markets. We haven't seen that kind of cheapness in price in the emerging markets really since the crisis in 1997 in Asia. Okay, so they're selling very cheap. We as investors seem to really just don't like to buy stuff when it's cheap. When it was going up for a decade, I keep buying more and more of it. But now that it's on sale, I think I'll wait until the prices go up, and then I'll buy some more of it. That seems to be how we're wired. I have this conversation. My son is, for some reason, thinking finance or economics as his career path. I don't know where he got that idea, but that's at least where he's kind of going down the road right now. He's taken his intro to econ classes, buy low, sell high, Econ 101, the first concept that you learn. And I said, Austin, you will struggle for the rest of your investment life to actually do that, because we're not behaviorally wired to do that. It is hard for us to buy things that have made us poor and stressed, and sell stuff that has made us wealthier and happy. And in investing, that is actually exactly what you need to do. If everybody could buy low and sell high, there would be far fewer people probably standing up here giving talks. Because if you do that and repeat that for your entire working life and through retirement, it's kind of like, lather, rinse, repeat, or whatever is always on the shampoo bottle. You do that over and over again, you do quite well. What do we do as investors? You saw that chart earlier. What do we do after the recession, 07 and 08? Never want to own an equity again. What do we do now after a 5-year run? We're kind of getting interested in getting back in these markets again, okay? It's very hard to actually buy low and sell high. That's kind of where the emerging markets are now. I know that there's different currency crises going on around the world. Argentina's gotten the headlines again. Turkey and their lira is getting a lot of publicity. Just to put this in context, the entire GDP, the entire market cap of Turkey, if you were to buy every share of every security in Turkey, is the same as Starbucks. Okay? That's its size. A couple other little fun facts too. We'll all be at Super Bowl parties, I'm assuming, this weekend. Go Hawks. Let's talk about a few other ones. The market cap that's traded in India equals the size of Wells Fargo. Okay? Brazil, Google. Okay? So sometimes when you see the headlines and what's going on in the world, you need to take a step back and go, all right, relative in size to things, I know that it's getting a lot of publicity. I know it can lead to other things. But as isolated items, let's put it all in context. That's emerging markets. It makes emerging markets sometimes hard to hold. Think about during our crisis, the worst asset class to be involved in as an investor during the Great Recession wasn't us. We didn't do well, but we weren't the worst. Emerging markets went down over 50%. 5-0. How many subprime mortgages are in the emerging markets? 0. They didn't cause that crisis. We caused it, but they went down more. So it's a difficult asset class to own. So what do we think? We boil it down to a few things. 90% of the world lives in an emerging market. And 50%, again, not 15, but 50, again, of everything produced and consumed in the world is produced and consumed by an emerging market or a consumer in the emerging markets. You probably have a very modest allocation in emerging markets. It goes on sale once a decade. It's not a bad idea to maybe pick up a few shares. Talk to your advisor. Don't go too far the other way, because it's hard to live with. The investment experience is difficult to live with, okay? You got to see through some days and some weeks like we're seeing right now in order to get the prize, which is the years like last year that just sometimes come out and they're better than people think, and you got to be in the game in order to get them. So have enough. Have the right time horizon, but just think about that within the context of a portfolio. If you have maybe a 5% or a 6 or 7% emerging markets allocation, it's probably okay based on demographics, income levels, how fast those countries are going to grow. We don't recommend picking one over the other. We own a lot of them. We let our managers make overweights and underweights. You know, if you get it right, you're up 90%. Congratulations. If you get it wrong, your entire retirement is blown out of the water. Diversify and take the advantage, though, of the income and demographic levels. So you can probably tell from my talk so far, we're actually okay on equities. I think there's good stories all around the world. Now, I don't know which one of these is going to play out first, so we own them all. We put a little bit more money in the U.S. this year because, again, we like the fundamental story here. Housing's a good story still. The consumer's getting healthier. Corporations are getting healthier. And this energy wild card, I think we're just starting to see the impact on the world. Whether or not we export it or not, we'll let our friends in the other Washington figure out what's the right thing to do with that policy. But in the meantime, the biggest input cost that businesses have here in manufacturing is energy. We are going to become, and already are, brutally competitive in our ability to manufacture from where we were just a few years ago. And think about the demographics of the world again on this one. The rest of the world's consumer middle class, led by China, is getting to be massive. They are no longer just going to export and send things around the world. They're going to consume and buy. Consuming classes around the world at a time when we're going to be even more effective in sending stuff around the world, that's not a bad position to be in. I'll hit on China briefly. We do think China will grow between 7 and 8%. Is China growing at 7 and 8%? I don't know. What I do know is China's going to tell us they're growing between 7 and 8%. So we can all debate and talk about whether they are or they are not. They have trillions in reserves to help them through this period. They are no longer growing at double digits. We know that. They know that. You can't. You're the second largest economy in the world. Double-digit growth is hard to maintain. Ask anybody that's working at Apple right now, how hard is it? You sold over 50 million iPhones and you were a disappointment this quarter. You reach certain sizes, it's very hard to grow at that. But China will now navigate. Again, they're going to stop building things and they're going to start buying things and populating these cities. Almost a little bit opposite of us. We probably need to buy a little bit less stuff and rebuild some cities or bridges and roads. They probably need to stop doing that and putting in consumers that will buy. The end effect will be they will be a huge influence, whether they're growing at 6, 7, or 8%. It's still at least twice as fast as anybody else in the rest of the world. Fits and starts. They will have their issues that come with that. But think longer run. Don't you want a piece of that portfolio, whether it's China or others? Mexico, what a great story. Other economies throughout Southeast Asia. Just put a little bit more in there and be able to ride that longer run. So that's kind of equities around the world. Let's briefly hit on fixed income. I don't really want to get out of the chart in here. It's a little bit messy, so let me just talk about it, headlines, and then we'll get to Q&A, because I'm assuming like all 3 cities have basically shut down for business in the last hour, so that's a huge burden for me. So I want to get you out of here. I want to get you out of here on time. Fixed income, yeah, we think interest rates are moving up. No big shock there. I know they've moved down over the last couple weeks. I'll take the odds that they're going to move up over time. We want interest rates to move up. If interest rates are still sitting in the 2% for a 10-year security a few years down the road, it means our economy is not really growing. They're going to move up because the economy is getting better. Interest rates move up as economies get better. We want that to happen. Again, we don't see inflation as being the real reason. We want interest rates to move up. We think they'll be modestly up by the end of the year, maybe 3.25%, 3.4%, as this economic information and people see it coming through that we're seeing for this year comes through. They'll move up. Now, the math in fixed income is very complicated. You need calculus degrees to really get into the whole concepts of duration and convexity, things that I don't talk a lot about in groups because I find I don't ever get invited back if I do. But if you simplify it, it's pretty easy. When interest rates move up, the price of your bonds moves down. That's all you got to know. Now, also the opposite is true. Why have you had great returns in your bond funds for the last 20 years? Because interest rates have gone straight down. When interest rates go down, the prices go up. All right, so if we're entering a period in where interest rates are going to move up, yeah, the prices are going to move down. Now, along the way, you're going to get to buy securities with a little bit higher interest rate, which is great. But that'll kind of combat how much the price goes down. So what do you get from fixed income moving forward from here? I don't know, flat to the coupon rate. Not the great returns that you've seen, not the horrible returns, though, that gets talked about a lot in media, because we just don't see a scenario where rates move up very quickly. So what does this, again, mean for your portfolios? If you have a time horizon long enough, and it doesn't really even have to be that long, now would be a good time to think about maybe shifting some of that money you have in fixed income to equities. And in a few years, when interest rates move up and you're getting paid a decent interest rate, nothing says that you can't shift it right back. All I would ask is a few things, and then we'll go to Q&A. Number one, don't just plow it all back into your home country. I know you want to, A, because we're wired that way, and two, we've had great returns this year, and again, we love to buy things after they've already gone up, right? It's the way we're wired, okay? Think about sprinkling some of it around the world, whether it's in large developed markets around the world or a little bit more into emerging markets. Number two, don't make a drastic move with your fixed income. Yeah, I might like equities over fixed from here. Not because I know what equities are going to do, but I got a pretty good idea that fixed income is going to be in this very modest, low single digits return. I'll take the other side of that. Do I own fixed income, though, in my portfolio? Absolutely. Why? Because I like to sleep. In months like we've had so far, I'm really happy that I have fixed income. I might not think it's going to be a great investment long run, but it is the best diversifier to the equities in your portfolio, and this month has proven it. How much you should move? I don't know. That's why you talk to whoever you trust, whether it's your advisor, whether it's whoever you use for that kind of advice. And I highly recommend you do that because it's much easier for somebody else to step back and look at your investments and give you recommendations, because we get so personal about our own investments, so passionate, so exuberant at times, and so scared. And as an investor, those are the absolute times we make the worst investment decisions. Let somebody else help you through that, but it's all moving it around the edges and on your plan. It's not making drastic changes of, I want to sell everything that's fixed and move it into something else. And that usually doesn't work out very well. So, everything in moderation, as you can probably tell, that's kind of our mantra at Russell. We recognize that we didn't get 30% in our portfolios because we didn't put all of it in U.S. equity last year. But over long periods of time, we want to provide a return for clients with a risk level that they can survive. Okay? You got to stay in the game to get the good stuff. So you own things that do well in markets that are a little softer or down in order to have enough in equities, basically, in order to do well in the up days, for whatever your dreams and your goals and your use of that money is. That's the real underlying message. If it helps, please turn any of us in the media off when you see us on TV. I get my 3 minutes anytime that I'm on. I know what I'm going to say. I don't care what the question is. I know what I'm going to say, because I've done the same media training that our friends in the other Washington have done. I'm going to say something. I'm going to sound compelling. You're going to say, that guy makes sense. Someone's going to come on after me after the break. They're going to get their 3 minutes. They're going to say the complete opposite of what I just said. They're going to sound interesting, and they're going to sound compelling. I don't know what you do with that information. So use this for education. Use this for entertainment. Some folks on TV are far more entertaining than me. I think you've already figured that out. Just don't act on that. Take that back to that person that you trust, that advisor, and say, does this make sense for me or not? And mainly, please, educate your kids and your grandkids. Don't let them get scared out of these markets. They're going to live to be 120 years old, and unless you want them living with you for a long period of that time, I would encourage you to have them embrace markets. Just don't put all their eggs in one basket. I will turn it back, and again, if you have questions, you want to stick around, it'll be my pleasure. But great to come here, great memories of being here, and here's to a good 2014. Thanks.